Welcome to the Advanced Health Plan's second installment of our Compliance in Employee Benefits series. We're going to be talking about myth versus fact and what is the real story. I'm Jay Kempton with the Kempton Group, and my co-host here is Maria Robles Meyers.
Good morning.
She is the Advanced Health Plan's on-staff counsel, and we're about, I think we're right at 10 o'clock, so we're going to go ahead and start this morning. The first thing that, as I said before, we're going to go through is just common myths. And if you all have been on our webinar series before, you'll notice that we try to take compliance issues and boil them down into actual applications of compliance issues that a community bank may face out there. So we're going to talk about some common myths that we hear when we're out talking with the banks and also from our clients. And then also hopefully address some of the factual responses to some of those myths. Now, Maria, the first myth that we're going to talk about is, now that the Supreme Court has decided and for those of you all that don't know, PPACA is the Patient Protection and Affordable Care Act. We may call it Affordable Care Act or whatever throughout this presentation, but the Supreme Court has decided, and so now all the questions are answered, and PPACA will no longer be challenged. Is that right?
That's the probably the latest myth that exists. On June 28th, the Supreme Court issued its ruling, but the Supreme Court actually rules on only very specific questions that have been posed to it. So the questions that were posed to it were answered, and the one that has the most consequences, the one that says that the individual mandate is in fact constitutional because it could have been passed as a tax under the tax code, and therefore it stands. That being said, that's really the very, very beginning of all challenges. I think there will be more to come. I know there have been several that have been filed already, both by religious organizations and employers that have religious affiliations that are not church kind of entities, but
right.
Individual owners that have specific religious preferences, and they're already coming up the ranks. Litigation is a very slow process. It has to start at the lower courts and move its way on up. I think we're going to see more. I think the exchanges will be challenged in terms of how they're operated, particularly in states like Oklahoma, where we don't have a state exchange and the feds have to operate it. No one knows how it's going to work. And so I think we're going to see a lot more challenges coming up, and it is certainly not the end all as far as that decision at this point.
And when the Supreme Court actually struck down the portion that the federal government cannot coerce or threaten to pull away funding to the states if they did not increase their Medicaid enrollment, that really threw a monkey wrench into, really made this issue even more murky.
Very, very, very significant change. And I don't think anyone understands the impact of that yet, because the concept has always been that the more people you get into the healthcare system, then I call it Obamacare or PPACA, but the more people that are in the system, then the law is efficient because you do then cover the non-covered.
Right.
But where you can't force the states to pick up employees into their or individuals into their Medicaid programs, it is going to impact how many people come up into the system, and it potentially could leave that gap of uninsured still out there, and the whole mechanism as to how it's supposed to work will fall apart.
Yeah. So anyway, on the bottom line of the myth and the fact, definitely challenges to PPACA are not over. Oklahoma, Texas, and Louisiana are just three states in our area that have said publicly that they will not be increasing their Medicaid population, and therefore will not be creating a state-based exchange. And so that's like we had said, that's a big hole in the Affordable Care Act as far as how that is going to be implemented and everything else. But it's one of those stay tuned kind of issues. Advanced Health Plans is going to be marching right along, though, with its compliance items that it is mandated to do. But stay tuned, and we'll keep you informed on this. Now, here's one that came up just here recently, and that is the myth that the Affordable Care Act has a lot of free services now. Now that this is passed and it's the law of the land, now there's a lot of things that people have had to pay either a portion of it, either in a deductible or a copay, and now all of a sudden that's all free now. What a deal!
It is a deal.
If it was not a myth.
That's exactly right. Free is not free. Free means the participant is not paying any portion of it, so it's no cost to the participant, but the plan still pays.
Sure.
A person who goes in and gets a physical may not have to pay the doctor a thing, but the plan is still going to pay the doctor a fee for the services that are provided. The concept, and this is really kind of an integral part of how PPACA is supposed to work. The concept is that if you create a system whereby preventive kind of services are, quote, more accessible or free so that the individuals are able to participate in them, that it will somehow translate into an environment where we are a healthier environment, thus lower the cost and
more proactive as opposed to reactive. More
proactive, but healthier, meaning less disease down the road. And the reality, I don't think, has yet been proved. The trend seems to be that healthcare costs go up. Whether we're getting sicker or not getting sicker, healthcare costs go up. The trend also indicates that older people get sicker. I mean, it's a reality. Our bodies fail. The older we get, the more prone we are to be sick. The reality is most people get the largest portion of healthcare in the latter years, sometimes
Sure.
really in the latter months when they become very ill. So this concept that by providing free preventive services to participants, we are going to somehow reduce overall cost has yet to be proven. I think there's a lot to be looked at, and I'm not sure that we're quite there yet. I think it's going to take a while before that settles in. The sad thing is that people do perceive this as a free kind of service, but even when it's free, people don't necessarily take advantage of the preventive services.
I was going to say that that very thing is, Advantage Health Plans has had a lot of very enhanced wellness or preventative type services long before the Affordable Care Act.
Yep.
And what we found is, we all know, claims are always an issue. Cost is always an issue. And so, you say, well, how can that be if you have so many preventative services out there? Whether they're low cost or no cost to the individual, it's going to, most likely it's going to fall out the way it always has, and that is the people that are more healthful in their mindset. They have a wellness inclination. They are going to be the ones that utilize the wellness services, and the folks that, healthfulness and wellness is just not an issue for them. They're not going to use the services, whether they cost them something or if they're free.
I think the problem with that is the majority of us are not
right.
The healthy, focused type of individuals that we ought to be.
Yeah. Okay, this is one that is kind of near and dear to our hearts here at Advantage, and this was one that right around the 1st of August, we started hearing on the nightly news and the newspapers and everything that effective August the 1st, women's contraception and several other women's services are going to be free effective August 1st, and literally our phones were melting there for a couple of days. And of course, the mainstream media out there never really made the distinction. It just said, if you're a woman, these services are now available to you August 1st, and that was kind of the end of the story. But there's a lot more to it, isn't there?
There is. The day that that portion of the law became effective, the news lines were 47 million women now have benefits they didn't previously have.
Right.
And the reality is mammograms have been around for a long time. Physicals have been around for a long time. They've had the benefits. What has changed is the perception that every plan is required to provide prescription benefits. And, just to give you a little background, August 1 is a magical date from the government point of view, only because there are a number of educational institutions that tend to use August 1 as the start of their plan year because that coincides with the school year. And when these regulations were drafted, the whole purpose of them was to make sure that they brought these people into the PPACA compliance now rather than waiting until next year, August 1 of 2013. And so it was really important to them that the regulations become effective August 1 of this year so that there would be that lack of a delay. That being said, it is August 1 or the date that your plan renews. And that's where the tricky part is, because for the school systems, August 1 is when their plan renews, and it made sense. For most other plans, they're calendar year plans, and it's a January 1 date. In other cases, it's a fiscal year plan, and it's July 1.
Right,
and
which is the case for Advantage.
Which is the case for Advantage. And so while it is being noted as these are benefits that are now free, the contraceptive aspect of it will not kick in into a lot of plans until 2013, either at the beginning or towards the end. That is one of the areas that is subject to strict contention right now. The churches are obviously exempt from providing contraceptives, but churches are true churches. You know, it's a Catholic church, it's a Baptist convention, it's a very specific group. And the issue has come up with entities that are controlled by or affiliated with these religious entities, or, as I mentioned earlier, the case of the employer that just has very strict religious beliefs and does not believe that that ought to be a portion of the plan. And as the law is written, there is no out for those people, right. And that's why the litigation is going to come up in this area.
It's going to continue. Also, there are plans out there that are also grandfathered. I know some of the non-bank plans that we do business with are grandfathered, and so this also wouldn't apply until 2014, or if they lose their grandfather status.
That's right, and the same thing for the plans that have waivers.
Right.
And those are generally the mini meds or limited scope benefit plans, and they're plans that are offered. They tend to be offered by industries that are like the fast food industries, where the benefit is significantly less than what you would find in
not a true comprehensive benefit plan.
It's a very limited benefit, and most of those don't provide the contraceptives at all.
So anyway, the bottom line on this myth is really can apply to a lot of future myths that we want to be sure that make sure everybody understands is with the Affordable Care Act. We're talking about a massive piece of legislation, and there are so many caveats and nuances to the law that, especially when it comes to when peace implements, that I'm sure that the news channels and the newspapers, instead of going through all that minutia, they just, whatever the press release is, whatever the easiest date to roll out, that's the date that they trumpet. But we all have to be very careful and listen or ask a deeper question is I wonder when that affects my plan. So again, stay tuned, or if you have any questions on those things, always feel free to give us a call. Okay. Medicare eligibility. This is one that we've seen in our banks for years. There's probably not a bank that I visit that this does not come up if I'm speaking with the HR people. And that is, I have employees who are eligible for Medicare on my plan, and since they're very expensive for my plan, is there any way that I can pay them to help them find other coverage, or somehow incent them to come off my plan and take Medicare?
That is a question that's been around a long, long time, and a lot of people still don't understand that they can't. Medicare was designed to protect what Congress perceived as the working aged, which are those of us who might be close to 65.
That term just feels wrong to me. But
that's what the statute
code,
says.
Though,
it's
right?
the working aged.
Okay.
But age 65 is when Medicare kicks in for most people, and so the concept was, if you are still working, then rather than the government having health care provided, but rather than the government providing the health care to the individual, they should stay on the employer's plan. And it's a cost-shifting statute that was specifically intended to keep those people that had access to other health care being on the employer's plan rather than on the government system.
Now, there's an exception, though, isn't it, for smaller employers with
under 20
lives?
Yeah,
right.
Under 20, which is a very small employer.
Yes.
You don't see.
We do have a few banks though that are under 20 lives that does apply to.
It's a small group. The interesting thing about it is, because it's a statutory cost shifting, where the goal was for Congress was intending to make sure that the employer picked up the cost. The strings that have been attached to it are pretty significant. It is illegal to ask an employee to get off your plan. It is illegal to offer them an incentive to get off the plan. And illegal in this sense means it's not only a bad thing to do, the consequences can be pretty severe, because there are criminal penalties that can be applied. And if you remember, criminal generally means something other than money. It means jail time. most employers are not willing to pay or play that game.
Right.
An employee can always make a voluntary choice to get off of a health plan.
Right.
But it has to be their voluntary choice. It cannot be coerced. It cannot be induced. And you have to be extraordinarily careful to not have a voluntary decision and the compensation go on the side where you're buying additional policies or paying other costs, other health care directly.
It's voluntary, but we're going to reward you for making that voluntary decision.
You have to be careful of how you reward someone who makes the voluntary choice.
Right.
But you definitely do not want to ever encourage or coerce an employee to move on. The criminal penalties really are significant.
Right. And you know, as administrator for Advantage, this is something that is always, you know, it's one of those tempting things. You're like, wow, you know, maybe we could save some cost for the banks out there. It's just not a viable legal strategy for us to take. So that's a big myth that we see out there. And then who's going to tattle on me? This is, I don't know that I have a lot of bankers that use the word tattle, but it is the heading of this myth. But the myth kind of goes that, you know, I'm a small employer, and so the Department of Labor will not be auditing my plans. Or it doesn't matter whether or not I comply with these various laws when it comes to employee benefits. No one's going to know. I've run into this, not that a bank is willingly just completely skirting the law, but a lot of banks don't get real excited about, well, you know, if my plan document for my 125 plan is not up to date, or if I don't have one, or things of that nature. Being that, you know, bankers have so many things on their plate right now, it's just tremendous. And so, you know, I think a lot of times having the correct documentation in place, it does kind of fall to the back of the stove, or maybe even off the stove. But this is an area in which things are changing. So we want to talk a little bit about that.
You know, I think this is probably one of those things that's actually really changing, and it's changing fast quickly now.
Yes.
Because it is generally a revenue raiser for the entities that are doing the audits. Audits are being done by the Department of Labor, which has responsibility for making sure that employees are protected. And they're being done by the Internal Revenue Service, which has the authority to make sure that you're paying taxes on the things that you're supposed to be paying taxes, and not taking deductions on things that are not permissible. Right. And this is kind of where all of this hooks up. In the last couple of years, the Department of Labor has trained an awful lot of people to audit, and they're auditing items that are very current. Historically, audits have been retrospective, and you're going 3-4 years back at things that happened, you know, changes in the law 3 years ago. Now they're auditing, like on PPACA. We had audits last year on health plans where the DOL was in there to audit whether or not the employer was in compliance with PPACA, and PPACA hasn't even gone full board in terms of the implementation.
That was very surprising to us that you know, the ink is barely dry on so many of these regs, yet the Department of Labor is out there looking for even interim compliance.
And what is changing is the sanctions and the penalties, the excise taxes, the fees, you know, call it whatever you would, the charge that you're going to have as an employer for failing to comply has gone up. So whereas all of these benefits in the past had been pretty much under the radar because no one was out there really looking at it unless you got picked up for something different.
Got a complaint against you.
Now the audits are more specific. And you got to keep in mind that the employee benefits area, the audits for the larger employees, 100 or more, are coming off of the 5,500s because it's really easy to pull a sample of companies to audit. But the IRS is auditing smaller employers as well. I had one recently where it was a 2-person retirement plan, and the IRS came in to audit for compliance on the retirement plan for 2 people. And, you know, 2 years ago, that was something like, what are the odds?
Yeah.
Not good. You know, it's kind of like a Powerball win. It'd be very hard to get audited if you're a 2-person plan. And today you're going, comply. Yeah. And, you know, usually it is much, much better to comply voluntarily. It is much better to fix mistakes because they do happen. Get them, you know, get the issues resolved and then move on, than it is to have someone come in and audit and find out that you have a problem, because at that point the penalties are higher and the fees tend to be higher, and they're not as easy to negotiate down.
And, you know, for those of y'all that have been kind of following the national news and everything, you know, PAPACA had funding for a tremendous funding to greatly enhance the IRS's enforcement area. And you kind of look at it that a lot of it is revenue generation based. There's a lot of penalties out there, and that is revenue to the government. And so it's kind of like they baited the hook out there, and they're out there fishing for that penalty revenue.
And, as PAPACA goes into full compliance, the penalties get even more steep for employers who don't comply with all of the ins and outs of the law. And that is a revenue, that is the revenue side of the statute. Yeah. That is how they balance it. The other thing I want to make a mention of is when you're dealing with arrangements that are employee benefits, generally the employer has a deduction for the cost that it's incurring, whether it's a retirement plan or the health plan, the amount of money that you expend. And what is happening is if you don't do it right, you can lose the deduction. If you lose a deduction, you have taxes. Most of us are not tax exempt employers. So if you lose the deduction, it has significant consequences, and it has the penalties and the late, interest and everything else that adds up to it, and it can be high pretty fast.
Sure can. Okay, this is one that we see very frequently for those of those Texas banks that are on the webinar. It's rare that we don't see this type of an arrangement within a Texas bank. Texas banks generally have much higher deductibles than we have here in Oklahoma, but we do see a lot of these arrangements also in Oklahoma. And the myth goes that I can partially reimburse my employees for the cost of their deductible or a portion of their deductible, and I don't need a document to do this. Many times that we'll ask them, okay, well, you have a $3,000 deductible. And yeah, we have a $3,000 deductible, but we fund it down to $1,500 for the employees. And so the employer is putting in $1,500 to buy down that deductible or pay down that deductible. And then we'll ask, well, what type of a plan are you using? What vehicle are you using to be able to do that? And more often than not, we'll hear this comment, well, we just do it, which kind of sends shivers up our spine. So we want to make sure that we address that.
Written documents. As an attorney, it is always interesting when you have an arrangement where you're giving an employee a benefit and it's not spelled out.
Right.
I tend to look at black and white letters. So if it doesn't say it in black and white, it probably doesn't exist. And it's very difficult to enforce, and it's certainly easy to challenge because you can change it at any time. Written documents are critical, and they're critical for several reasons. One is if you make reimbursements to an employee, and you're not doing it under an arrangement that is sanctioned. Remember, it's IRS deductibility issues. Like in your high deductible example, you would use an HRA, which is a health reimbursement arrangement. It's a simple document to draft, but if you're paying the employee back on the amount of money that they're out of pocket without having it in writing, then you potentially will cause that employee to have taxable income. Mm-hmm. And the employer will have a different kind of deduction. It may not be a deduction that is subject to the medical expense reimbursement. It may be compensation subject to employment taxes, and you may be subject then to the FICA, the Medicare, the other costs that go with it. And that's where the issue comes up. I always tell people, if you have a benefit that you're going to give an employee, put it in writing so that it is well understood as to what it is intended to be. Now, I'm not talking about the thing that you do for one person where you might make an exception for a particular deal that you want to do one time for one person and you do it voluntarily on an agreement basis. That's different than having a fixed arrangement like where you're reimbursing for the medical deductible portion. The other place you see this is in cafeteria plans.
That's right.
When you take
especially
portion,
premium only.
Even premium only. When you take a portion of an employee's paycheck and reduce their paycheck and use that to pay for healthcare costs, that is an item that is not taxable to the employee. It's not included in their compensation. It's not subject to Social Security or Medicare or FUTA and any of the other employment taxes. But if it's not done under a written document, there is no sanction. It is taxable compensation, and you as the employer are now subject to the payment of those taxes. And since you messed up and didn't collect the employee's share, you get to pay their share as well. Yep. I've seen some audits where IRS has looked at that, and the first thing they say is, well, show me where that is. Show me the document. The other area where it comes up to play is sometimes with state law. when you have money, when you're taking money out of a person's paycheck, like in Oklahoma, you need to put it in writing.
Right.
So having an election, whether the election is on an
Should
annual
be a
basis
voluntary agreement, mutually agreed to.
that's the deal. It has to be documented to indicate that it's voluntary and you did agree to it. Otherwise, it looks like you're taking money without the employee's permission, and when you do that, you got other issues as well. So in writing,
Absolutely,
no matter what.
And like we had talked on our previous webinar, not only in writing, a correctly structured plan document, but with all the new laws coming out, these plan documents, if you don't have one, you not only maybe have an issue from the deductibility, but if you don't have some of the model language that PPACA or some of these other pieces of legislation are mandating that be in the document, I mean, you also run the risk of having a penalty for not having the PPACA compliance.
Not compliant. And just as a word of caution, because I see this often, internet is really nice to go do some searching, and it is inevitable that you will find documents that say they are cafeteria plants or HRAs or whatever else it might be. What they don't tell you is how old they are, and they don't tell you whether they were correctly done to begin with. So be careful out of just pulling a document out of the internet and applying it to yourself, and then believing that that's going to be the end all.
Or the facts that are in the plan somehow don't fit your particular situation. So,
I see a lot of that self-lawyering. Doesn't go very far when you make a mistake.
Yeah, well, you broke me of that, that's for sure. Okay, moving on. This one is a cutesy little slide, but size in this case does not matter. The myth is that I have a self-funded plan, but I'm a small employer, so my plan is not subject to any of the discrimination requirements. And that is most definitely a myth.
That is absolutely a myth. Self-funded plans, group health plans today under PPACA are basically a plan of two people. And the rules keep getting more and more narrow as you define plans. I think at times people thought that if they were a small employer, they could do away with some of the strict requirements simply because no one was looking and no one was going to look. Scrutiny being what it is today, small doesn't really mean small. And the smaller the groups, the more problems you tend to have. Non-discrimination rules basically require two things. One, that you provide the same level of benefits to everybody, and that you make them available to everybody. And if you keep in mind that discrimination rules are generally geared at situations where individuals were attempting to benefit generally the higher paid or the highly paid employees, because those are the ones that were more valuable to retain. And so the discrimination rule tends to be where you provide your higher paid individuals a better benefit structure, an earlier benefit structure than your rank and file people. And these non-discrimination rules really don't allow that. There's some confusion in the marketplace. In the self-funded arena, the non-discrimination rules have always been applicable for forever and ever, as I can remember. In the fully insured product, the non-discrimination rules have not been applicable. PPACA does make them applicable today. They're currently not active only because the IRS has not been able to generate enough documentation to figure out what the rules need to be. But they're coming. So that is going to be the rule regardless of what the structure is. And discrimination is definitely not one of those areas where you want to apply, because failure to comply is bad. In the health area, the failure to comply with these self-funded arrangements, and you benefit the highly paid people in a way that is discriminatory, it can translate into having someone be taxed on the benefits they received. And I'm not talking about the amount that they paid into it. I'm talking about the cost of the benefit that they got, the hospitalization charges, whatever was paid to them for the benefits they incurred could suddenly become taxable to them. And that's not a good situation to be in if you have an individual that receives benefits.
Okay, control group. Who's got the control group?
One of my favorites.
Yeah, we see this more often than not with the mergers and acquisitions, and a lot of times banks and bank ownership getting more and more diversified. This is an issue, and I think it's a growing issue. And the myth goes like this: I own two companies, whether it be a bank or a bank and something else, but I own two companies. One has 18 employees, and the other has 17 employees. Since neither one has more than 20 employees, I'm not subject to cover rules. Or I own two companies. One has 40 employees, the other one has 25. And since neither one is more than 50, then FMLA, I don't have to worry about FMLA. And those are definitely myths.
That is definitely a myth. And if you notice, the two examples, COBRA and family medical leave, both are the adverse selection kind of deals. And usually they will come back and bite because it's someone who's entitled to some benefit that you didn't provide because you thought you didn't have to. And then you open your eyes and you go, whoops, I do. Control group rules have been around a long time. They are unfortunately rather difficult to apply. They're very, very simple. If you own a company outright.
And might just interject, and I know that a lot of our audience is our HR and your HR at the bank. This is one of those issues that, you may have to reach out to senior management to talk a little bit more about this because we may be talking about, the other co-owned entity you may not be responsible for whatsoever.
May not even be aware of it.
Yeah, but the ownership of the bank could have an issue.
It does, yeah. And rule of thumb, just big basic, because these rules are very complicated, but a rule of thumb is basically if you have two or more entities that have an 80% commonality of ownership, then they are considered a single employer. Now, keep in mind that under the current scheme, most business owners try to put different businesses under different company names, really for protection, liability protection, or for tax reasons.
Yes.
And so you end up having multiple entities that are intended to protect the employer from the liability aspect of the business that they're running. But when you look at it from an employee benefit point of view, what happens is the employee benefit side disregards legal entities and it treats all of the employees that are in the multitude of entities as if they are employed by a single employer. So when you're doing the discrimination test, when you're doing the COBRA 2020 employee rule, when you're doing family medical leave 50 employee, you're looking at the aggregate number of employees in these entities in order to figure out whether or not you're really subject to it. The rules came about way back in the early 80s for retirement plans, originally to protect employees who were in the companies, and they weren't bankers, they were probably lawyers who wanted a company that gave benefits to just the lawyers, and then the rest of the staff was in a different company. And they said, but there are two companies, I can do it here. And they said, oh, no, you own them. Okay, so then they got creative. And that's why the rules are difficult to apply. PPACA actually incorporates these rules very strongly into its structure because, again, the goal of PPACA is more inclusive healthcare. So the bigger that you spread the company size, the more you can rein in and capture, the better it is to achieve the overall goal of having fewer individuals be uninsured. The only other thing I want to say and mention to you is control group rules also have under the tax code a funky thing called the attribution rules.
Yes.
And that means that if you have a spouse, you can designate so that I own my business and my husband owns a business and we share employees and stuff, but hey, he owns one, I own the other, neither one, we don't have common control. Well, the attribution rules say what your spouse owns is attributed to you. What you own is attributed to your spouse. So you have to kind of watch for it. It gets complicated in the banking arena where I've seen some of the changes is you have a lot of family ownership and you have trusts that are owners with children or grandchildren, and you really got to watch those attribution rules for children and grandchildren because they filter up on lineal lines to parents and grandparents. Yeah. So be careful of attribution rules. If you think you have a control group issue, you probably need some legal advice, and I'm not saying it to sell legal services. They are complicated rules, and they're difficult to apply. Very, very fact-specific.
Sure. And, one of the ways that this usually will come up for us is where, you have a bank owner that owns maybe a couple of different banks or a bank and another entity out there, and maybe they have two different type of health plans. Maybe one is a very low deductible, very benefit-rich plan, while the other entity is a much less rich benefit plan, and that could open up the bank ownership or the owners of the control group to discrimination problems. And that's how it would manifest itself, I think, most of the time.
That's how it comes up. And just so that you're aware of it, just because you have two different arrangements doesn't necessarily mean that it's bad.
Right.
But it means that you have to test it to determine
comparable.
That you comply with the rules. So if you've got a very even population and, it's evenly spread, or you have your highly paid people in the lower benefit plan,
Yeah.
You might pass a discrimination test, but
Right.
the deal is you have to test it to make sure that you did it. You can't just assume that because it's offered to that group that you're okay.
Yeah, that's right. Those are all good tips. Okay, workers' compensation. In my 21 years, I've seen a lot of these, and they're just like that bad penny. They always turn up, and it's just something we always have to work through. But the myth, it does have to do with workers' compensation, and it goes like this. My spouse is, and this is an example, but my spouse is a plumber who offices out of our house, and he works out of his own truck. But because he's self-employed, he doesn't need to buy workers' comp. That's what my health insurance is for, right? And usually when this myth is exposed is usually when there has been an injury. So it's one of those things that go along until there's a claim, and then there's a surprise.
And again, it's that adverse situation. You don't know about it until you need the benefit.
Right.
Most health plans don't provide coverage for injuries that a workers' compensation policy would cover. That's been, historically, that's just been the way it's been done. State law mandates
if
that...
the majority of plans did, there wouldn't be such thing as workers' comp.
That's the deal. And then state law generally mandates workers' compensation arrangements that have to be provided, and they are designed to provide the worker. That's the bottom line. They're designed to make sure that the worker who is injured on the job has access to medical medical coverage and time, get value for the time that they can't work because of the injury that occurs on the job. That being said, we tend to have a lot of people that are self-employed or that are family businesses that don't employ outsiders. They only have individuals that are within the family, and they believe that if they have a health insurance policy or coverage through their spouse, that's good enough.
Mm-hmm.
Because they're just doing their own thing and they're not paying
Right.
attention. And I think what complicates it, it makes it confusing, is state law does not require a self-employed person to actually get workers' comp insurance. They can opt out. That doesn't mean it's not available.
Right.
But they can opt out. And people interpret the opting out as meaning
I don't need
to have it. And then you get the plan that won't cover it. The disclosures on the plan, you don't see it saying no workers' comp injuries covered up front. It's an exclusion in the plan.
Sure.
And it's a very, very standard exclusion in self-funded plans. It's a very standard exclusion in fully insured plans. It's been around.
It's majority of it, you see it. It's very rare that you don't.
It's very rare. And, the solution to it, if you would, is if you are self-employed, be sensitive to the fact that you have got to get coverage that provides coverage for you while you are at work.
And this is really not so much a bank compliance issue, because we never run into a bank that doesn't have workers' comp insurance. I mean, and a lot of times injuries that occur on the job at the bank they're relatively straightforward. I just think back some of the more vivid examples. Somebody gets a finger chopped off in a vault door. We've had that occur, and obviously there's never a question about whether that's work-related injury or not, but it usually ends up with the spouses. That aren't bank employees. That's where the confusion tends to set in.
And we've seen them. The one that comes to mind for me that was really a really tragic situation was an individual who was, I think, a welder,
Mm-hmm.
and was working with obviously I don't weld, it was working with the tanks and the stuff that welders work with, and it caught on fire. And
Right.
he had significant damage and burns to his body because of the fire that was created. And, and then you have to go, well, is it a hobby that this person is participating in, or is it work? And when you find out it's work, the plan doesn't cover that.
That's what he did for a living.
That was that he was self-employed. He was, that's what he did. And that was a pretty bad situation.
Yeah, definitely. Okay, moving on. And this is one we threw in. This is the last myth, but it's important, and it's an introduction to some things that we're going to be talking a lot more about in the future. So we just kind of think of this as a bonus. It's not a compliance myth, but it is an employee benefits myth. So what? It's all the same price. And the myth is that all network doctors and hospitals, if they're in your PPO network, they're in your book, then they all charge the same for the same service. So if I'm getting my big toe worked on and I'm utilizing a doc or hospital that's in our PPO network, then I could use any doctor or hospital in the PPO, and they're going to charge the same thing to work on my toe. And it's a big myth.
It is a big myth, and it is probably one that is being put out in the written press and in the television more and more right now. People are finding out that healthcare does have a cost.
There's a front page article in the Austin paper about this about 2 weeks ago. It was the lead story.
Yep, CNN, ABC, a bunch of other news stations ran the story about 3 or 4 months ago on a similar issue on an appendectomy in California, and the research that a doctor had done out there with respect to the cost at various facilities for an appendectomy. And people were shocked to see that it could be anywhere from $3,000 to $180,000. And you're sitting there going, $3 to $180, that's quite a spread. But that is what has happened.
Within the employer's PPO network.
And some of them all were within the PPO network. I think what people have to understand is when you have a PPO, by law, the providers in the PPO are not allowed to sit and agree on prices, because that's considered price fixing and it violates antitrust laws. And we certainly don't want price fixing.
Right.
So they don't sit and agree on prices, and the PPO does not dictate what a provider can charge. It just facilitates that provider having access to the provider, but not to the pricing.
They facilitate a discount, but they're getting a discount off a $3,000 charge that charges much lower than a discount off a $180,000 charge.
That's exactly what happens. And so in today's world, what people are finally, I think, coming to starting seeing, and it's a slow process, it's kind of like a giant waking up, is that healthcare services are really not that different than other consumer type of services. So whereas most consumers have no problem when shopping for a car doing comparison pricing and checking to see what it is, consumers don't do comparison shopping and have no gauge to even use when they're looking for health care.
You're using the example of a car. As a guy, cars or flat screen TVs, I mean, we'll spend a month surfing the internet, researching things down to every feature, the price, the location, the warranty, everything before we make a purchasing decision. And, a lot of times, if you're buying a flat screen TV, there may be 20, 30% difference in price from a great deal and a not so great deal. In healthcare these days, we're seeing pricing variability that is ranging somewhere. Sometimes it's in excess of 400% for the same service within the PPO network. So it's stark, and I think plans are going to start talking more and more about how they educate their participants into finding out what the cost variability is and steering them towards the more efficient, lower cost providers.
And, from the employee or participant side of it, generally what has happened historically is the participant will go into a hospital and they'll be told what their deductible is and what their out-of-pocket is, so they know what their value is, what their charges to them are going to be. And the assumption is that anything else that is billed is going to be paid by the plan.
Right.
And they don't take into account the things that are not covered, the things that are covered at special rates, the things that have conditions that are attached to it. And what's happening, and you hear it in the news, someone is going into the hospital and now they're in bankruptcy because their healthcare costs are outrageous. And people don't focus on the fact that means the plan never did cover it, but they never asked. And the myth that I think we're talking about is people assume that everything is fairly priced and that what they are charged is only what they're told they're going to be charged in an out-of-pocket amount or in a deductible amount. And when the reality sits in and that bill comes in, suddenly the story changes because now it is their liability and it impacts how they deal with their life going forward.
Especially when you're talking about a self-insured employer or one that is part of a larger self-insured plan like Advantage. You said something that, the employee is interested in what it costs them from their out-of-pocket deductible, so on. And then they assume that the plan is going to pay the rest of the bill. And even when the plan does pay the rest of the bill, the thing that a lot of times the bankers out there and our customers tend to forget is the banks are responsible for both sides of that. The plan is your employees, because if the plan pays more, that simply makes the premium increase or the contribution increase the next year that much greater. And so we really, as a team, as a group, have to educate our employees that whenever the plan pays, that plan is not some third-party deep pocket. The plan is us.
It's our pocket. It's our money. And, and I think as PPACA unrolls, there is more and more of an attempt to educate at some levels by making people more conscious or more cognitive of what is in their plans, like the summary of benefits, which comes out next year. It's intended to make people become more aware consumers. And I think the concept is rather new in healthcare, and that's why it feels like a myth.
Right.
But the reality is it's here to stay.
Yeah.
Informed consumers, no matter what the product, including healthcare, are going to be the best consumers. And it pays to understand.
You bet. As
be
Americans,
knowledgeable.
we have to do better.
Be knowledgeable.
So that's the end of the presentation. Now we are going to open it up to questions, and so I've got. Hopefully, I have the chat box open correctly, and if there are any questions or anything, we are available to take those now.
While we wait on questions, Jay, as we were gathering the information to put on this presentation, there are so many things out there that really would qualify as myths.
Oh, yeah.
The list is really very long.
This was an easy presentation to put together, that's for sure.
It is amazing sometimes what people assume happens in a health plan, and they really don't get it until something bad happens. And usually the something bad is you've got high bills or somebody's got coverage. I'll give you an example of one that I saw recently, and it was an individual who was involved in drinking and driving, an illegal activity. And no one ever contemplated the fact that because the individual was charged with driving under the influence, that was considered an illegal activity and not covered under the terms of the plan. Because people look at what their deductibles are, what their co-payments are, and they often don't really look at what the exclusions are. But when you get hit with the hospital bills for these things that have taken place, and now you realize the plan pays nothing, it is your bill, it's sometimes shocking. And they look at the plan as saying, well, that's not fair, that's not right, you need to pay it. And you go, but that's in the black and white, remember?
Sure.
It's written. And if people were more proactive in availing themselves of reading the documents, especially the exclusions, they would really have an opportunity to make sure that the bad things don't happen.
The gotchas don't happen.
Because at the point that they got you, it's a little bit late to go backwards.
Without a doubt. Well, being the nature of this webinar, we may not have bankers that are wanting to, and I think we do have a question that will this webinar be available online? I'll bet you that's the question. Yes, absolutely. It will be archived on the AdvantagedHealthPlans.com website in all of its glory. So you can actually either download the slides or you can actually just watch the entire video from start to finish. And that should be up 2 or 3 days. It should be up there once we get it converted and uploaded and everything. Now, the thing that we wanted to, we have one more question coming in. Okay, I have a question about partial reimbursement of deductibles. We have considered offering only an HSA plan to our employees and make the employer contribution to help offset the high deductible. Would this need to be a written document that you mentioned, and would it be subject to employee taxes?
I think the contributions that are made by an employer into the health savings accounts are not subject to taxes, but you do need to put it in writing so that you articulate what it is that you do and make sure that it's basically non-discriminatory and it's across the board for people. But it should be in writing.
Yeah, and I think if I'm correct on that, I do believe that it kind of depends on whether or not your bank is going to be holding the HSA funds or if some other entity is doing that. But think the employer is still probably responsible for documenting that into some sort of a plan document, regardless of who holds the funds.
Health savings accounts generally require a custodian, and there are a certain group of entities that have been authorized to be the custodians because the individual has direct, it's like an IRA account. The individual has direct access to their health savings account, and they get to choose when they're going to spend it or whether they're going to leave the money in there. So I think it doesn't really matter. I don't think, in my opinion, I think the arrangement is the same no matter what. Where the money is held.
So you could have multiple. You could have multiple custodians as employees are free to choose.
Yep. Yeah. Harder to administer, but you could.
Right. Okay, looks like we have another. Let's see here. I just ran into a situation where I found that a medical equipment company owned by an in-network hospital was not in network. The assumption was that it would be in network too. Boy, I've seen that one before. As far as the medical equipment company, that's probably not the most common situation. Probably the most common situation of this is I'm having a surgery, I go to an in-network hospital, I make sure that my doctor is in network, but they bring in anesthesiologist to my surgery that I never met, never saw, and they were not in my PPO network. Those are ones that we actually make some allowances for. An out-of-network equipment company, that's going to be kind of done on a case-by-case basis. Just honestly, that's going to be one of those things that it kind of gets under my skin. It's an issue for us out there. I would just suggest that you send an email into customer service, and there are instances where we can make an allowance on that under Advantage Health Plans. But the way we're going to look at that is, did the individual have a choice as to where they got that equipment, or was it the only place in their community that equipment could be had?
Jay, if I could interject a minute. This is a classic example, I think, of what we see in the marketplace today, where individuals have the assumption that the doctor is taking care of them, or the facility that, whatever the provider is taking care of their best interest. And the consumer, the patient, doesn't ask, is this facility in my network? Is this provider in my network? Because they assume that it is. Yep. And that's,
that's a logical assumption.
It's a logical assumption, but it's part of the myth that, somebody else is taking care of you, as opposed to where I think we're headed in the future, and that is the consumer being proactive and asking the question. And I think, it's unfortunate that it happens because, like I said, usually when you get it back, it's something that's been denied or something has been paid at a much lower rate than you were anticipating the payment would have been. But this is a classic example of where informed decision-making really, really helps. Because you have the ability to say, what are my options? And let me check on the 3 facilities that I can get it at, because I want the one that is in network. And it doesn't matter whether you own it or don't own it. But if you don't ask, if you don't have that consumer mentality in really seeking to be informed of what will happen, then you get the surprise.
Right. And just if I was to look into my crystal ball into the future of healthcare, and we're going to talk a lot more about this at the annual member group meeting that is going to be held in Oklahoma City on September 12th at 3, and then also we're going to be having a Texas member group meeting that's going to be held via webinar on September 25th at 10 a.m. for our Texas groups. We're going to be talking more about this, but looking into my crystal ball, there is a time within our lifetimes for sure, probably within the next few years, where I think, as Maria was touching on, I can see a day where there are no more networks, and we hopefully have just more informed consumers where we can go wherever we want to, but we want to be more informed on what is a reasonable cost for different items, and before that patient has to go and buy that medical equipment or their physician they go and find a physician to do a procedure, that they know up front what a reasonable cost is, and also know what their plan is going to pay, because the network games that this question kind of highlights. it's becoming worse and worse and worse. And it's not just an advanced health plans issue. It's rampant throughout the industry, and it's a big problem. I think those are the end of our questions. I want to make sure that we get to our obligatory attorney disclaimer because Maria said so. Obviously, this presentation provides information of a general nature, and if you do have specific fact-related questions, we ask that you either give us a call or go see your own counsel to get fact-specific answers. Did I say that right?
That's close enough.
All right, very good. Well, if it's close enough for Maria, it's good enough for me. And again, if you do have more questions, please feel free to reach out to us. And we are going to have the third installment of the Compliance and Employee Benefits webinar.
It's actually the fourth.
Excuse me.
It's the fourth and final of the year.
That's right. But it's the third that we've
Third
done
video.
video.
Yeah.
All right. Okay. Thank you. I'm glad it's keeping me straight there. But it's going to be on October 16th at 10 a.m. and it's going to be looking towards the future. We're going to be talking more about probably healthcare reform, one of our favorite topics, and anything else that is pertinent at that point in time. So we really appreciate everybody's time and attention, and I hope this webinar was useful and provided some good information to you and your bank. Thanks again, and everybody have a great rest of their day.